Hey there, welcome to TechWorldGBA, your go-to channel for all things tech. If you love staying updated with the latest in technology, gadgets, and tutorials, you're in the right place. In this video, we will look into index funds. Navigating the investment landscape can seem daunting, especially for beginners. However, index funds stand out for their simplicity and effectiveness. Imagine a basket of fruits representing the stock market. Each fruit is a company's stock, and an index fund is like buying a pre-selected basket that mirrors a specific market index, such as the S&P 500. By investing in an S&P 500 index fund, you're essentially buying a small piece of the 500 largest publicly traded companies in the U.S. Index funds are passively managed, aiming to replicate the performance of their underlying index, resulting in lower fees and broad market exposure. This approach reduces the risk associated with investing in individual stocks. Market indices serve as benchmarks for measuring the performance of different stock market segments. Well-known indices include the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. The S&P 500 comprises 500 of the largest U.S. companies, representing about 80% of the total U.S. stock market capitalization. Investors use market indices to track the overall health of the stock market and benchmark their own investment returns. Index funds provide a convenient way to gain exposure to these indices, simplifying the investment process. Passive investing involves tracking a market index rather than trying to outperform it. Index funds are a prime example. This approach contrasts with active investing, where fund managers actively trade securities to beat the market. Passive investing has gained popularity due to its potential for long-term growth and cost-effectiveness. Studies show that passive investing often outperforms active investing in the long run, providing consistent market returns. The simplicity and effectiveness of index funds make them a cornerstone of many investment portfolios. Let's explore popular index fund options. The S&P 500 index funds are a popular choice for U.S. stock market exposure. These funds track the performance of the S&P 500 index, comprising 500 of the largest U.S. companies. Beyond the S&P 500, other index funds cater to specific sectors, industries, or investment themes. For example, technology enthusiasts might consider index funds tracking the Nasdaq 100, while those interested in emerging markets could explore regional index funds. Understanding these funds can help investors make informed decisions aligned with their financial goals. The Vanguard S&P 500 Index Fund, VFINX, is a titan in the index fund industry, known for its low-cost passive investing. VFINX boasts an incredibly low expense ratio, enhancing long-term investment outcomes. Over the years, VFINX has consistently delivered competitive returns, closely mirroring the S&P 500 index. Despite its popularity, VFINX focuses solely on large-cap U.S. stocks, so broader diversification requires additional investments. Nonetheless, VFINX remains a compelling choice for U.S. stock market exposure. Fidelity's Zero Large Cap Index, FNILX, offers a zero expense ratio, making it an attractive option for cost-conscious investors. FNILX tracks the S&P 500 index, providing broad U.S. stock market exposure. Fidelity's decision to waive all expense ratios has intensified competition among index fund providers. While FNILX is relatively new, its zero expense ratio makes it ideal for long-term investors. Like VFINX, FNILX focuses on large-cap U.S. stocks, so broader diversification requires other investments. Diversification is key to mitigating risk and enhancing long-term returns. Relying solely on S&P 500 index funds limits exposure to large-cap U.S. stocks. To achieve true diversification, consider index funds tracking small-cap stocks, international stocks, bonds, and real estate. Small-cap stocks offer higher growth potential but increased volatility. International stocks provide diversification beyond the U.S. market, while bonds offer a lower-risk alternative. Real estate investment trusts, REITs, allow participation in the real estate market without directly owning properties. Index funds offer broad market exposure, low-cost structure, and simplicity, making them a cornerstone of many investment portfolios. They provide instant diversification, spreading risk across a broad spectrum of industries and sectors. Index funds are designed for the long haul, allowing investors to ride out short-term market fluctuations. Their passive approach saves time and effort, reducing the likelihood of emotional investment decisions. Index funds provide a set-it-and-forget-it investment solution, allowing investors to focus on other aspects of their financial lives. Every dollar saved on fees translates into a dollar earned in returns. Index funds stand out for their cost-effectiveness. Actively managed funds have higher expense ratios due to constant trading and management. Index funds with minimal trading activity have significantly lower expense ratios. Even a small percentage point difference in fees can result in a substantial difference in investment returns over time. The lower fees associated with index funds allow investors to keep more of their returns, compounding their wealth over time. The world of finance can often seem like a labyrinth of complex jargon and intricate investment strategies, leaving many individuals feeling overwhelmed and intimidated. Index funds, however, cut through the noise, offering a refreshing sense of simplicity and transparency that demystifies investing and makes it accessible to everyone. One of the most appealing aspects of index funds is their straightforward nature. They track a specific market index, such as the S&P 500 or the NASDAQ 100, providing investors with a clear understanding of what they own and how their investments are performing. The performance of an index fund is directly tied to the performance of its underlying index, eliminating the need to decipher complex investment strategies or analyze the track records of individual fund managers. Moreover, index funds are highly transparent in their holdings and fees. Investors can easily access information about the specific securities held within an index fund and the associated expense ratios. This transparency fosters trust and allows investors to make informed decisions aligned with their investment philosophy and risk tolerance. The simplicity of index funds extends beyond their investment approach. They are readily available through a wide range of brokerage accounts and retirement plans, making it easy for investors to incorporate them into their portfolios. The ease of buying and selling index funds further enhances their appeal, providing investors with flexibility and control over their investments. While index funds offer many advantages, they are not without limitations. Index funds are tied to market performance. They can't outperform the market. In downturns, they mirror market losses. However, they offer a predictable investment experience. The financial markets, much like the vast and unpredictable ocean, are susceptible to waves of volatility. Economic downturns, geopolitical events, and unexpected news can send ripples through the markets, causing prices to fluctuate and investors to scramble for safety. Index funds, while offering diversification and a low-cost investment approach, do not provide immunity from these market risks. When the market experiences a downturn, often referred to as a bear market, index funds will inevitably decline in value. The extent of the decline will depend on the severity and duration of the market correction. Investors who have allocated a significant portion of their portfolio to index funds, particularly those heavily weighted towards equities, may experience paper losses during such periods. It's crucial to remember that these losses remain unrealized until the investments are sold. Index funds, with their long-term investment horizon, encourage investors to ride out these market fluctuations and avoid making rash decisions based on short-term market movements. History has shown that the stock market has consistently trended upwards over long periods. Despite experiencing periodic downturns, investors with a shorter time horizon or a lower risk tolerance might find market volatility unsettling. It's essential to assess your risk tolerance and investment goals before allocating a significant portion of your portfolio to index funds. Diversifying across different asset classes, such as bonds or real estate, can help mitigate the impact of market volatility on your overall portfolio. Index funds, by their very nature, are designed to track the performance of their underlying market indices. This inherent characteristic, while a source of their simplicity and predictability, also presents a potential limitation: the possibility of limited returns, especially when compared to the allure of high-flying, albeit often speculative investment opportunities. In periods of robust market growth, index funds will steadily climb, reflecting the market's positive momentum. However, their returns will be capped by the overall market's performance. Actively managed funds, with their potential for outsized returns, might seem more enticing during such periods. Investors seeking to chase those market-beating returns might find index funds too tame for their liking. It's essential to remember, however, that consistently outperforming the market is a challenging endeavor, even for seasoned professionals. Actively managed funds, while carrying the potential for higher returns, also come with higher fees and the risk of underperforming the market. Index funds, with their steady-as-she-goes approach, eliminate the pressure of chasing elusive market-beating returns. Moreover, the simplicity and low-cost structure of index funds allow investors to focus on what truly matters: saving consistently, investing for the long term, and letting the power of compounding work its magic. By embracing market returns, rather than trying to outsmart them, index funds provide a reliable and efficient path towards building long-term wealth. Building a solid investment strategy with index funds. Index funds are simple, cost-effective, and offer long-term growth potential. They are ideal for both novice and seasoned investors. Leverage their strengths to align with your financial goals. Index funds provide accessibility and broad market exposure. They serve as core holdings in a diversified portfolio. Index funds are flexible and adaptable to various strategies. Dollar cost averaging, a steady hand in the market. The financial markets are inherently unpredictable, susceptible to swings in sentiment, economic fluctuations, and unforeseen events. This inherent volatility can be unnerving for investors, particularly those prone to emotional decision-making. Dollar cost averaging, a time-tested investment strategy, offers a disciplined approach to navigating market volatility and mitigating the risks associated with timing the market. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. For instance, an investor might choose to invest $500 in an S&P 500 index fund every month, regardless of whether the market is up, down, or sideways. This consistent investment approach takes the emotion out of investing, preventing investors from making impulsive decisions based on short-term market movements. When the market is down, dollar cost averaging allows investors to purchase more shares at lower prices. Conversely, when the market is up, investors purchase fewer shares at higher prices. Over time, this approach tends to average out the purchase price of investments, potentially enhancing long-term returns. Dollar cost averaging aligns perfectly with the long-term investment horizon of index funds. By consistently investing over time, investors can ride out market fluctuations and benefit from the power of compounding. This disciplined approach is particularly well-suited for investors who are just starting out, those with a lower risk tolerance, or those who prefer a hands-off approach to investing. Asset allocation. Finding your investment balance. Asset allocation is the strategic distribution of investments across asset classes like stocks, bonds, and real estate. It aligns with your risk tolerance, investment timeline, and financial goals. Index funds are valuable tools for effective asset allocation. Determine your risk tolerance to start. Higher risk tolerance means comfort with volatility for higher returns. Lower risk tolerance prefers stability over potential upside. Allocate investments across asset classes based on your risk tolerance. The enduring significance of index funds in a diversified portfolio. Index funds offer broad market exposure, low costs, and simplicity, making them essential in diversified portfolios. They help balance risk and reward, providing a reliable foundation for long-term financial goals. Their low-cost structure ensures investors keep more of their returns, maximizing wealth accumulation. Index funds democratize investing, making it accessible to all and remain reliable companions in the financial journey. Don't forget to subscribe to the channel and hit the notification bell so you never miss out on any of our informative videos. And if you enjoyed this video, make sure to like, share, and leave a comment below. We'd love to hear from you.